IP is an asset class that's emerging from the shadows. It's been with us for many years. On the investor side, you have famous investors like Warren Buffett, who recognizes IP in the businesses that he invests in, whether it's Heinz with their great brand and trade secrets around the products and the taste of the products, whether it's Apple or whether it's See's Candies. He only invests in companies that have strong IP or a strong economic moat, as he calls it. But for us, that translates into IP. And so what does that mean? That means brands, patents, software, technology, and you can see this in his portfolio. And then at the other end of the spectrum, you have investors like Peter Thiel, who invests in early stage growth companies. He was the founder of PayPal and other billion-dollar exits. And again, he only invests in companies that have a strong competitive advantage, that can dominate their market and use IP to do that. There is demand in the market, and the market, ought to respond to that demand. And that demand is now being generated and being guided by what's happening in the United States. And as we all know, what happens in the US often influences what happens in Europe and Luxembourg. And in the US, we are seeing regulators of banks and lenders to venture debt, tech finance, growth finance, providers of capital like that now have to take much more care and do much more diligence when it comes to lending to IP-rich companies. The US regulators are saying you need to get IP valuations, you need to get IP scores and benchmarks, and you need to do more diligence in order to better understand these assets as collateral. And I believe that will influence the emergence of more private credit funds against the backdrop of the controls and the diligence that the US regulators are looking for. And so I believe that with the US leading and with the demand that's in the market, then capital from Europe will be able to meet that demand through these new IP asset focused credit funds.